Hello and welcome to Market Domination. I'm Jared Blikre in for Josh Lipton, and we are live from our New York headquarters. There's just an hour to go until the closing bell, and it's only noon Eastern time. Stocks are in rally mode to close the month of November. Let's take a quick look at the Wi-Fi Interactive, where we have the Dow, the NASDAQ, the S&P, all trading to the upside. I'm going to put a chart here of the intraday trade. Actually, this is month to date. Look at this. We just turned positive in the Dow. Now let's take a look at the intraday. It's been up and away from the lower left to the upper right there. S&P 500, very similar chart, though lower returns by just a smidge, 0.4%, and a similar story for the NASDAQ. And looking at the small caps, Russell 2000, which has really come alive over these last 5 days, that is up another 0.5%. And just getting a quick check on the bond market, we are up 2 basis points in the 10-year Treasury yield to 4.02%. In the 30-year, we're up 3 basis points to 4.67%. And just a quick look at the sector action. We do have healthcare leading to the downside, but everything else in the green. Energy up 1.5%, followed by financials and materials. And let's continue this conversation about the markets. Stocks are higher as we march toward the close of the last trading day of November. With just 1 month to go in 2025, we want to zero in on the top sectors to target and avoid through year end with Alex Spencer. He is a Bogart Wealth Chief Investment Officer. Alex, great to have you here on this, it could have been a quiet Friday, but I think investors are celebrating. It's been 5 straight days of incredible gains here. What are you making of the month of November?
You know, we had a bit of volatility, and after the Fed meeting that we had, Powell kind of temper expectations around interest rates. We saw a little bit of movement around that repricing as folks unwound some of the interest rate expectations for December cuts. And now it looks like it's coming back down. We've had subsequent rhetoric that kind of recalibrated some of those thoughts. And here's the excitement coming towards the end, and perhaps a little Thanksgiving Day celebration.
Yeah, and let's talk about the AI trade a little bit and some of the sector rotation that we've seen. AI has taken a bit of a backside. It's been blistering hot at times, kind of coolish recently. And if we go to the Wi-Fi Interactive, I have the month-to-date sector returns. Number 1 is XLV. That is healthcare, kind of a come-from-behind story. Also the leading sector this quarter. Then we have materials. Then we have staples, which is a bit defensive. Energy too. And if you notice what's dead last, that is XLK. That is tech down 5.1%. Also consumer discretionary, another mega cap sector. What are you making of this right now, Alex?
I mean, it's fair, right? We've had quite a strong run, so a little bit of profit taking, especially as we're trying to calibrate some things to year end on the data side as data is coming back online. So folks are doing a little bit perhaps of defensive rotation, but you know what? Sectors that we still like is still information technology. We still like communication services, and we also like industrials. When we talk about AI, and all the things in technology, what we see there's secular strength that's going on decades now if you step back. I mean, we can talk about electricity, we can go to internet, we can look at software as a service, and now it's AI, and then robotics on deck and quantum computing thereafter. So a lot to like here on a long-term lens, and as well, if you want to get into the strategic national economic, security conversations, it's basically a 2-horse race between U.S. and China. So a lot to see there as you're seeing U.S. get more involved with some of those conversations. Government, 10% stake in Intel, for example, right? We can throw the U.S. Department of Defense, 15% stake in MP Materials. So I still think there's a lot to like, but some breather here is, we can respect that.
Sure. And let's talk about some of those strategic partnerships, because that caught me by surprise. I think it caught a lot of investors by surprise this year. And just thinking about the longer term implications, trading for 2026, what should an investor be thinking about a government that is taking stakes in a lot of these big chip companies, not just Intel, but in a variety of related industries?
Well, look, first let's get the obvious out of the way. Ideally, we want a free market economy, right? That's what everybody wants. Now, it's important to realize on a macro scale, there's plenty of countries out there that put a lot of subsidies and support into their local industries. China stands out there, but even in Europe, you get a lot of that. The question was, how do we get some of the chip manufacturing back in the US? How do we steer some of the minerals and rare earth mining processing back in the US? And when you saw a government do that, it kind of created some support and basically endorsed that this is a real thing that we need to focus on. NVIDIA $5 billion partnership, all of a sudden into Intel. I don't think that would have happened without some of that government support. So there is, again, when it's national economic security, that's the conversation that we're having today.
I want to talk to you about healthcare, which I mentioned at the beginning, that come from behind story. We have seen not only XLV, that's a big healthcare ETF, and it covers some of the majors too, but also biotech, which is like the tech field for pharmaceuticals and for healthcare industry. That has come from behind, and we're starting to see the ETF flows back that up. And that's the first time we've seen that by my count, in years. So what do you think about the healthcare trade and any other sleeper trades like that you might have your eye on?
Yeah, so if we're talking the defensive kind of category names, I do like the healthcare side. You have the secular, growth stories there, the demographic trends to back it up. GLP-1 drugs now come into conversations. So there are growth drivers in the healthcare sector. So that's a good development to see. I think that's a good area to be in to balance out some of the portfolios of the more growthier names. Some of the other, defensive sectors that are, in general get to asset heavy business models with property, plant, and equipment and all that. You get skinnier margins, you have a lot of leverage. Healthcare balances some of that, a little bit stronger growth stories.
What about retailers? Because this is the season to be shopping, and we've seen kind of a bifurcated market. We go to the Wi-Fi Interactive. I have the month to date on our retail heat map. What stands out is Amazon, the biggest one in the ship here. That's down about 5%. Home Depot also down. Shopify. But we got some big winners too. Walmart hitting record highs today. It's up 9% this month. TJX, similar boat in terms of returns and hitting highs. Ross Stores up 11. So what about the retail space?
Retail is an interesting one. It's really one I would say we got to get a bit more selective and kind of, parse through. Something like Amazon gets caught up with the AI story. So if some of that's temporarily selling off, you're going to get some of that pressure. But also you can see retailers, been a little bit more insecure about their labor market status and their job situation. However, on the aggregate, they're doing okay. So what you're seeing, though, is more cautious consumers that are focusing more on the necessities versus the luxury items. In a short, simple way to tell it, you can look at Target versus Walmart, for example, right? People are trading down, getting the necessities. However, you could make the argument that perhaps as some of that confidence will one day return, some of those retailers that focus more on the premium brands might actually be providing us an opportunity here to get some names on a discount.
And what about sectors or industries, even individual names to avoid? What things don't you like right now?
For us, it remains in when we look at the defensive sectors, it's the staples, energy and real estate. And in particular, I'll point out energy, in energy space. And again, it depends on your time horizon.
Sure.
When you look at it long term, I look at something like West Texas Intermediary, oil futures curve, pricing oil to be about at this price, 60 per barrel for the next 10 years or so. What that starts to look like is a more capped industry, a more capped sector. And if you look at something like EV trends, EVs make up 20% of the car fleet right now. It's projected to be about 50% by 2030. So it just feels a little bit, it's stable. However, the upside, if that's what you want, I think you got to go into the more asset light business models where the profit margins are just stronger. And then on the real estate side, that'd be another one I would point out. Right now, we're just dealing with a lot of interest rate costs. You got the affordability crisis situation. It's just, and home builders having to throw out incentives out there to buy down mortgage rates. You're seeing cost pressures. And the other thing I would bring up for the staples is, remember, we had a lot of front loading of inventory goods, right, earlier in the year, which brought cheaper goods, which has helped with the margin side. They haven't seen as much of the pass-through costs to consumers just yet. The question for me is what happens now as they start to restock those shelves? Do they still continue to eat those costs, or will they pass it through to the consumers? You already have a skinny margin side of the market, so it's just more uncertainty. So it's about balance, but in this area, it feels a little bit more capped on the upside.
Yes, I agree. It's about balance. Unfortunately, we got a commercial real estate guest coming up and also a toys specialist. So thank you for all your insights there and for joining us this Friday. And coming up, we are going to be talking all things Black Friday shopping next on Market Domination. Mobile is officially taking over this holiday season, with Adobe projecting that more than half of all holiday purchases going to be made on phones as retailers double down on apps and loyalty programs. For more, we are bringing in Natalie Kotlyar, National Retail Practice Leader at BDO. Thank you for joining us here today. And let's talk about that headline stat. Adobe is saying that more than half of holiday purchases is going to be on phones. And we talk about the K-shaped recovery or the consumer, but there's almost a story of have and have-nots with retailers, and some are embracing the latest technology, some are not. So talk to us about that story.
So let's talk, first of all, thank you for having me today. So let's talk first about the statistic. And what does that really mean? So the consumer today is more tied to their phone than ever. Every consumer has a phone and they use it consistently. So retailers, if they can pivot and if they can manage to create that incredible experience for the consumer on the phone, that is why mobile shopping is up. The consumer really, it boils down to three things. When you think about what's important to the consumer, it's number one, value. Number two, it's convenience. And number three, experience. And the question is, does the mobile device bring that? Can the retailer deliver on that? Value can mean in terms of discounts, pricing, quality of the product. And then the convenience and the experience is where the mobile device comes in. Can it be a seamless shopping experience? Can it be easy to make that purchase? And then what's the experience that the mobile device is providing to the consumer?
Yeah, the experience is key there, because sometimes I get inundated with offers and that just kind of turns me off to a brand, makes me want to unsubscribe from their text messages or delete the app. But what about loyalty programs? How important are they, and the strategy behind pushing some of those alerts out to consumers?
That's a great point. I'm with you on canceling some of the subscriptions that I have into these emails. But loyalty is going to be a key factor for lots of consumers this year. Loyalty used to be just sign up and get an initial 5% or 10% discount. And retailers are really taking loyalty to a whole nother level. It has exclusivity, so you can have exclusive products, exclusive times to purchase, and then there's also tiered discounts. If you purchase X number of dollars, you'll get 5% off. If you purchase Y, you get 10, so on and so forth. And that's really in an effort for the retailer to keep the consumer coming back, to keep them making that purchase in one place.
And what about this K-shaped or two-track consumer? We've talked a lot about the difference between the high-end consumers and the lower-end consumers, and what kind of products are buying, the stuff that they want versus what they need. What does that look like?
So certainly the K-shaped economy is playing a role in this. Whether you're looking at the average consumer or at the affluent consumer, the average consumer is going to be, everyone has a fixed budget. Mm-hmm. And the average consumer so much more so. So they are really going to be looking at what promotional deals are out there, what discounts, what value can they buy, can they find. The affluent consumer may be more into the convenience factor or the experience factor. It's certainly a divergence, but I do believe that these three things that I mentioned are so critical to each consumer.
And what about, we talked about AI on the retailer side, on the app side. What about the consumer side? I've seen ChatGPT and Gemini really lean into making that search experience for products kind of integrate with potential buys. And how is the consumer changing and responding to the ease of AI that it's bringing to the market?
Absolutely. The AI is playing a big factor for the consumer, right? So there's the ability to do comparison shopping that retailers really need to make sure that their products show up in that space. There's also, as you mentioned, the visual search is critical and very important for the consumer today. In fact, I was doing some research earlier. I went into a department store and I could see that the consumer is using their mobile device to do the comparison shopping.
Yeah. I got to talk tariffs for a second here, and also the effect that that's had on inventories. We've talked to a number of guests who said that inventories are looking good right now because they were pulled forward, but once they run out, that's a different story. So how is that impacting shopper behavior, and what should people be looking out for and thinking of as this kind of story evolves over the holidays?
So retailers that have a very strong back end, right, where they're using AI, whether they're using strong supply chain, strong inventory management, predictive analytics, those are the retailers that are getting their inventory at the right price, at the right time, at the right location. From a consumer's perspective, they really need to understand what they're looking for and who has it.
Okay. What about buy now, pay later? That is an option that we've seen grow in popularity over the last few years. Is that still going strong? Is that something that consumers are really still leaning into?
Absolutely. As we head especially into the holiday season, because consumers want to buy, consumers need to make that purchase for the holidays. And given the fixed budget, consumers are really leaning into the buy now, pay later option.
All right, given everything that you've seen here, tariffs, softer budgets, mobile, AI, which type of retailers look the best positioned this season?
That's a really good question. So the retailer that understands their consumer, understands what their consumer values, what they need, creating that exceptional experience for the consumer is going to be the winner. There's always going to be winners and losers, as you mentioned, but I do believe that the retailer that truly understands what's important to their consumer and provide that to the consumer in today's environment is going to be the winner.
And hopefully the consumers are the big winners this holiday season. Thank you so much for joining us here, Natalie.
Thank you.
And now it is time for some of today's trending tickers. We're watching crypto stocks, Starbucks and GameStop. First up, we got to talk crypto. Shares of Coinbase, Strategy, and Bullish all trading higher as Bitcoin hovers around $91,000, regaining some ground after a pretty bad start to the month. We spoke earlier with Michelle Schneider, MarketGauge.com chief strategist, about what she thinks about Bitcoin's bottom and where it is.
Well, I actually think that 80,000 might have been the floor in Bitcoin. Certainly, we saw a lot of money coming back into it, and here we are now over 92,000. So right now, I'm saying forget about 80. Right at this point now, we want to see it hold around 88, 89. We get through 100. I would think that's a good sign.
And joining me now to discuss is our very own Julie Hyman. And okay, I'm not going to ask you if you think the bottom in Bitcoin is in, but what do you think about the reaction of some of the stocks around it? I'm looking at the Wi-Fi Interactive, and it's not looking good month to date so far, as you would expect. So.
Yeah, I mean, this feels like a bounce, right?
Yeah.
From the bottoms, as Mish alluded to. One of the folks who agrees with her, by the way, is Jonathan Krinsky over at BTIG. You know him, he's a technical strategist there. And he says he thinks Bitcoin is now poised to continue its what he calls a reflex rally, which I thought was interesting, another way of saying a bounce,
That sounds so much better than dead cat bounce.
Yeah, it does sound better. And he says at least back towards 100,000. So sort of echoing what Mish said there. But one of the things I was looking at was the correlation between Coinbase, just to take an example, between Coinbase and Bitcoin.
Sure.
And we have the chart there, and it's a very high correlation. It's something like 0.89. Now, a one-to-one correlation is the highest correlation you can have. So 0.9 almost is a very high correlation. And so in other words, what does this mean? It means as goes Bitcoin, so goes Coinbase.
Yeah.
And that goes for a lot of the other crypto stocks as well. So even if Coinbase has a sort of more fully rounded business that isn't just Bitcoin, it's trading like it's all about Bitcoin.
Yeah, and as we talk to the CEOs and management of these companies, they don't want that to be the case. They would love to have diversified revenue streams, but we are, 10, 12, 15 years into the Bitcoin phenomenon, and they're still tied to that Bitcoin price.
Yeah.
Next up, we got to talk Starbucks. The coffee giant's worker union is escalating an indefinite strike to more than 120 stores in 85 cities. This comes as the company has struggled with more choosy customers these past few quarters. And this is a stock that has had trouble maintaining any kind of uptrends over the last few years. And what are your thoughts on this latest?
Well, I mean, the strike that has been ongoing now for a little bit, and this is just like an intensifying of this existing strike, it just sort of increases the noise around a stock that has already been underperforming, right? Brian Nickel, who came over from Chipotle to try and salvage Starbucks.
Yeah, great rep there.
Yeah, I mean, he does have a great rep, but he took over in September 2024, and the stock is down about 8% since then. It's down year to date about 4.5% or so. And so investors are just kind of not yet buying into that turnaround that he has been promising at Starbucks, right?
Yeah, I mean, longer term, I'm going to pull up a chart on the Wi-Fi Interactive. Let's go back 5 years, and you can see that's a whole lot of sideways chop right there for investors. And moving on, finally, we got GameStop. The meme stock is up ahead of earnings, which are due to be released on Tuesday. It's been gaining some attention this week, up over 12% in the last 5 days. And if I again go to the Wi-Fi Interactive, I'm going to show you the meme stocks, what they have done, and let's see if we can punch that up there. Well, this month to date shows a different story than we've seen over the last 5 days. You can see a lot of red there. Now here's the last 5 days. They have just come alive with some really outsized winners there. And the GameStop's 12% looks kind of small compared to some of these numbers. What do you think about the GameStop?
Well, if you pull up a GameStop year to date, the little bounce that they've seen over the past few days, it looks real little. So year-to-date chart, oh, there's the little tiny bounce there.
It kind of looks like a J.C. Peretz oops. You know, it just kind of undercut its low there for the year. This would be a great time for the Reddit YOLO crowd to say, oh, well, let's join and try to lift this stock. I'm not saying that's what you should do, but this would be one of those opportunities.
But that might be what's happening, right? Yeah. You know, and one of the reasons that perhaps we're seeing that increase is there is some like social media chatter that is increasing in volume about GameStop. So maybe that's, you know, people are talking about their favorite stocks over the Thanksgiving turkey. They decide they're going to get back in here. But let us remind people that the peak for this stock was over almost $90. It was almost $90. It was about $87, $88. That was back in 2021 when this first caught fire during the first meme stock frenzy. And it has never come close to re-attaining that peak. And so depending on where people if people got in there and they're still hanging on, bless them, right? Because that is a hold all holders. Yeah, I mean, that's a tough, that has been a tough slog for them.
But you know what phrase we haven't said in a very long time, Julie? Oh, thirsty cash.
Thirsty cash, love that.
So, you know what? I look at this meme stock board and that's what I think. You know, even Bitcoin got a little bit of a bounce here. So the thirsty cash is alive and well, I would hope.
I guess it is.
The holiday season. All right, thank you, Julie.
Thanks.
And Black Friday tech shopping is getting a lot more complicated this year, with tariffs and supply pressures quietly pushing prices higher on everything from accessories to video game consoles. Yahoo Finance tech editor Dan Hawley joined Market Domination Overtime on Wednesday to give us the landscape for tech shopping this year.
There's a kind of a complicated Black Friday situation here. Some good ways, some bad ways. We have obviously generative AI. It's finally, kind of taken off. Everybody is using it seemingly, just not my dad who can't figure out his iCloud password, but I digress. It's very helpful in that you can make more personalized requests when you're looking for gifts for someone. So for instance, my nephew is 8. He likes Legos, action figures, and sports. And so I could put all of that into something like ChatGPT, which now has a shopping offering. They just launched that the other day, into Microsoft's Bing Copilot. You could use Gemini, and they'll provide you with some really good ideas as to what to buy. I did not know that they make Lego sports sets, but apparently they do, and I found that out while shopping. So that's part of the good side of things. The bad side of things is that Black Friday is also going to have to contend with tariffs. And so, in addition to those gifts, tariffs will probably be under your tree if you have a tree in the morning on Christmas. And so, we're seeing things like electronics get hit particularly hard. You saw there, those video game console prices, they went up earlier this year in August and May. Microsoft's particularly hit hard. They had to raise the prices on their consoles twice. Sony had to raise the price on the PlayStation 5 by $50. Nintendo, that's the original Nintendo Switch, by the way, which came out in 2017. They raised the price on that. So, I mean, look, you have a console that's almost 10 years old, and somehow it's worth more money now than it was then. So, I mean, outside of depreciation and whatnot. So, we're seeing these tariffs impact different things. And then on top of that, computers are exempt from tariffs, displays are exempt from tariffs, but they're not exempt from the broader issues that we're seeing in the market, which is the data center build out. Memory is now getting more expensive, and not exactly clear if the pricing is going to hit before the holidays or after, but just keep that in mind when you're shopping. If you can find a very good deal, go for it. And as for those video game console prices, obviously they're usually big sellers for the holidays. I actually saw a PlayStation on sale, $100 off at Best Buy. If I didn't have one already, I'd be buying that for myself.
Well, here's what viewers want to know, Dan, of course. What are you buying? What is on the Howley radar right now?
Yeah, I think, some of the biggest gifts are usually things like headphones, fitness trackers, smartwatches. The Apple Watch is obviously a big seller. AirPods, huge seller. Pixel Buds for the Google set. Any kind of accessories you can get that are, relatively inexpensive but necessary. Good keyboard. Like, I know that's boring, but you're typing away all day. You're going to have something that's comfortable. Things along those lines, I think, are usually the most appreciated. We have a friend who we just had his birthday. Obviously, this is separate from the holidays, but we got him a charger for his phone in the shape of the Star Trek logo. He really loves Star Trek, watches it constantly every year. Really appreciate it just because it's not something that he would get himself, but was necessary because it looked like mice had been chewing on the charger that he had been using. I'm surprised he didn't start a fire. But little things like that are some of the things that people really like to get that they otherwise wouldn't necessarily buy for themselves. So I think those are the big thing. And then obviously, if you got a kid or you are a kid at heart, I guess Labubu's, I'm not even sure what's going on with those really. I remember Beanie Babies, never bought them then, wouldn't buy Labubu's now. Our producer, Dan, compared them to Pokemon. That's not true at all.
Dan, always great to see you. Happy Thanksgiving, my friend.
Much more market domination on the other side of this break. Zscaler shares inching higher today after sinking over 13% earlier this week after earnings. Zscaler CEO Jay Chaudhry joined Market Domination on Wednesday to discuss these results and more.
We delivered amazing results. ARR grew 26%. Our revenue growth was 26% as well. RPO accelerated to 35% year over year. And our free cash flow margin was 52%. In fact, if you take revenue and free cash flow together, we are performing at the rule of 78. There are very few companies in the SaaS world that are over $3 billion in ARR and are growing at over 25%. We're very ecstatic and happy with the results we posted.
Jay, I was talking to an analyst this morning who covers you all, smart guy, friend of mine, and he said, I'd like to hear Jay separate out Red Canary results, referring to the acquisition you all closed in August, from organic results. I think what he was really trying to get at, Jay, is organic slowing down? How do you answer that?
Yes, I think that's part of the confusion analysts had. But with Red Canary or without Red Canary, our growth was strong, our operating margin was strong. Red Canary is an important acquisition for us, but from contribution margins point of view, it's relatively small. The biggest thing they bring to the table for us is agentic technology that's allowing us to really do some of the security operations in a better way. So our growth on the top line as well as ARR was very strong without Red Canary as well.
Let me ask you, Jay, when you look into, through year end and beyond, what does enterprise spending look like, Jay? How would you characterize it? How healthy, how resilient?
So the macroeconomics haven't changed a whole lot. The market is tight, budgets are tight, there is deal scrutiny on large deals, but there are two situations where you can get the deals done and do the kind of growth we have done. Number one, enterprises care about cybersecurity, and especially now with cyber, along with AI security becomes a very important part. We do that very well. The second part is, since there's pressure on budgets, so CIOs are looking for cost reduction. They're looking for simplification, consolidation, And our platform can eliminate a lot of network and security point products. There's so many firewalls, VPNs, routers, switches sitting out there that can be taken out. We do that. So by combining great security with zero trust architecture and meaningful cost savings, we got a strong pipeline and we are getting deals done. That's really what's showing up in our results.
I want your take, Jay, also on the competitive landscape, the competitive environment. Is it getting more competitive at that enterprise layer, Jay? I ask because, hey, there's Palo Alto, CEO Nikesh Arora, very smart, impressive guy like yourself, Jay. He's out there making noise, making moves. You got Netscope in the mix. What do you see?
So from our point of view, our brand has gotten better and better when it comes to high-end enterprises. They understand zero trust architecture. They understand security very well. In my view, the competition has become less on the high end of the market. You talk about firewall companies. Firewalls are not zero trust architecture. The zero trust were invented because firewalls have failed to secure enterprises, and so many companies are getting breached. So comparing Zscaler to firewall companies is like comparing an electric car to an internal combustion engine car. Can you ever get to zero emissions with internal combustion engine cars? Never. So that's one part of the area. I don't really see firewalls as real competition. Then there are smaller companies trying to come and try to offer platforms. You can't expect a small company that's losing a lot of money to compete at the platform level. My competition is not really these vendors. If I face something, I face inertia. Lack of education, lack of awareness, because when you go to a new technology, you need to educate the customer market, and we're doing a good job in that area.
I want to dig into AI a bit more with you, Jay. Two questions. One, just help me understand how you're helping customers implement AI, Jay. And two, more broadly, I would just love to get your take about where you think we are in this great AI cycle.
Every CIO I talk to is trying to take advantage of AI. They're building applications, models, they got use cases, and early results are pretty positive. There may be some hype about it, but AI is happening and every CIO is pushing for it. In fact, it's on the agenda for CEO as well. But as they do it, cyber becomes a big worry for them, and that's what they talk to us, saying, how do you secure my AI applications? We got a number of products in that area, starting from red teaming, starting from guardrailing to agentic exchange. So that's one area we help them with. Also, to do good AI security, you need a good foundation of zero trust. We do that as well. Now, where are we in this journey? Pretty early stage. But we are beginning to see AI-driven threats and attacks happening. There's a deep fake a year ago. Recently, one of these AI companies, their agent was hijacked. A lot of these threats are happening. So AI is actually becoming a catalyst for the security business, and we are getting ahead of it to make sure we secure our customers.
Jay, I'm also curious what kind of impact AI is having on your own company. Jay, what are you seeing impact in terms of in productivity, headcount? Walk me through it.
So we are seeing tangible impact on productivity on certain use cases. I won't try to say AI is doing magic across the whole thing, but take meaningful use cases for customer support. We are seeing resolution of cases at a much faster pace. We are able to train our support engineers so they can really handle more complex cases assisted by AI. Very, very clean use case. Then you look at the second area, that's software development. Whether it's testing or some of the code generation, we are seeing tangible results. So the impact it's having is that rather than having to increase my headcount overall by X%, I can do a lower headcount reduction. The productivity numbers, you see different ranges all over. Some of the things we have seen in our business is somewhere in the 10 to 15% is fairly pragmatic.
Final question, Jay. I'm always curious to get your take on just the overall threat landscape, Jay. What do you see and how is it evolving?
Unfortunately, threat landscape is getting worse and worse. But it's natural, as more and more business goes online, as more AI tools become available, hackers also use automation of AI tools. Hackers are using AI tools to identify attack surface. So it is getting worse. The good news is that AI is also helping providers like Zscaler. We are using AI technology to find literally a needle in a haystack, identify some hacker activity that couldn't be picked up before. So using our technology, with all the data we have tremendous amount of data, about 500 billion transactions per day that no one else has. Because before anything bad happens, reconnaissance takes place. We can see that and identify those things sooner. So I believe we can fight AI with AI to keep our customers safer.
Coming up, we get a look at Newmark's 2026 commercial real estate outlook. Don't go anywhere. 2026 is shaping up to be a good year for commercial real estate, with data showing positive momentum across office, industrial, retail, and select specialty sectors. Joining me now with more on the outlook for commercial real estate is Liz Hart, Newmark, President of Leasing for North America. Liz, thanks for joining us here today. It looks like commercial real estate is finally out of the doghouse of the pandemic. What should investors be focused on finally here?
Yeah, absolutely. So if 2025 was the pivot year, 2026 is going to be the year of stability. And like you said, we're expecting positive momentum across all three sectors: office, industrial, and retail. Office demand is up 45% year over year. Really strong performance in the trophy sector. Industrial, with those three rail lines coming online, we're expecting to see a super cycle starting in the industrial sector. And retail, the quiet outperformer. They've been having a great couple of years, and we're expecting the same in 2026.
Let's just do retail because it is a holiday season. What are we thinking about in terms of the retail space this season? And then especially since we need a longer term outlook going into 2026.
Well, interestingly, and very on track with our Black Friday and with our New Year's resolutions, wellness and fitness is expected to be a pretty top performer in the first quarter of next year and into 2026. But Class A malls performing, single-digit vacancy in all of those Class A malls throughout the year, and very little new construction hitting that retail sector. So because of that, we're expecting outperformance across that segment for the remainder of 2026.
And with all the investor attention on AI, I think data centers, they just sit at the crossroads there. That is kind of a niche space, but we've seen it growing gangbusters. Is that sector priced for perfection? Is there continued growth in the pipeline? Just talk to me about some of the details, especially I think we need a longer term outlook, even more longer term than next year, as far as the AI trade is going.
I would expect data centers and AI to continue for several more years, 26 and beyond. But AI is not just about data centers, it's also about the tech sector. And the tech sector's had a tremendous year in 25, and we're expecting it to grow office demand through 26 as well. It's been up about 25 to 30%. And what's really interesting about it is especially in those big block office demand too. So deals over 100,000 square feet. And that's really been driving that Class A office demand sector as well.
And what about reshoring? That has been a huge term that we've heard sprinkled out throughout the entire year, kind of a pillar of the Trump administration. That's leading to more warehouses and logistical needs. How is that sector doing?
Well, big block industrial demand is up 63% right now. That's how high the leasing was up. Pretty surprising to see that kind of numbers, but I guess not surprising with the trends that we've been seeing from the Trump administration. So what we'd expect is really strong continued leasing, industrial leasing in those intermodal cities, including Dallas, Houston, Kansas City. We're expecting to have a super cycle in the industrial for the 2026 and beyond.
And you just mentioned some specific areas, some specific cities. Real estate is a very regional market. So what are some of the dynamics at play here? What parts of the country should investors be looking at when they're thinking about opportunities?
Yeah, like I said, definitely Dallas, Houston, Kansas City, Phoenix, those intermodal interchanges, that's where we're really expecting to see the most of the demand come in.
And what about some of the areas that there might be a little bit more slack in?
I mean, I think you could see a little bit of pull away from the coastal cities, but really we're focusing on where the strength is, and that's those intermodal interchanges.
Okay, let's talk about the hybrid office because that has had huge implications on renewals that are coming up. When you're sitting with clients or your colleagues are sitting with clients, what is the conversation around office space needs? How are those getting pared back? Is that kind of trend finally balancing here?
Well, we have $1.5 billion of renewals that'll be hitting the market between late 25 and 27. So quite a few that are coming. And what the demand is showing us is that 72% of the demand that's in the market right now is looking for the same size space or growth. So what that shows us is that the hybrid is really priced in right now. It's really in the market. And we really think that most companies, as shown by that demand stat, are looking for the same or more space. So hybrid is here to stay. That's not going to change, but it doesn't mean that people are looking for less space.
Yeah, I think hybrid is definitely here to stay. We've mentioned a lot of subsectors here. Where do you see the highlights? What are you looking forward to in the new year?
I think what I'm really looking forward to is just the stabilization across all three categories, office, retail, and industrial. It's been a long time since we've had good positive growth across all three sectors, and we look forward to that in 26. It looks like it's going to be a great year for commercial real estate. Okay, and I'm hearing a lot of optimism here. What could potentially go wrong in 2026, or what are some of the headwinds that the industry is still facing? Right now, it's looking pretty positive for 26, but as you know, there always can be a surprise that comes out of nowhere. We learned that in 2020, but nothing negative on the horizon right now. We're looking for a pretty strong year after a lot of recovery from 20 to 25.
Yeah, it only took 5 years, and I wish you the best here, especially over the holidays. Liz Hart, thank you so much.
Same to you.
And don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for more market domination overtime.